Hi everyone, my name is Victor Lai with BCM, and welcome to part 2 of Investing 101. I hope that you all enjoyed the first part of this series. In this second installment, we'll be taking a look at what we can do to protect ourselves against inflation over time. Before we get into it, let's just do a quick review of what we went over last time. In part 1, we talked about the importance of time horizon, and that's basically defined as the amount of time that money can be invested for. I define a long-term time horizon as a period that is longer than 10 years. Inflation is a concern in the long run because it erodes the value of money over time. And the bottom line is that for most of us, saving alone will not be enough to meet our future needs. In addition to saving, we need to grow what we save because, as we saw, doing nothing is literally losing. And to really bring that point home, let's do a quick example. Let's say you saved $1 million as of today, and you plan to use that money in retirement, which is still 30 years away. Assuming that inflation runs at 4% a year, that $1 million will only be worth $308,000 by the time you need to use it. Now let's also assume that you plan to spend $40,000 a year in retirement. You would be out of money in less than 8 years. $40,000 a year won't even cover living expenses in San Francisco. And by the way, we haven't even accounted for taxes yet. So the point is, because of inflation, saving by itself is probably not going to be enough. So the question we have then is, what can we do as long-term investors to protect ourselves against inflation? Now this next chart shows us the growth of $1 from 1925 to 2010 if that dollar had been invested in a number of different asset classes. The blue line represents stocks, the brown line represents gold, the orange line represents bonds, the red line represents homes as in real estate, and the green line represents cash. Not like cash in your wallet, but like cash in a savings account that earns interest. Clearly, the blue line has outgrown everything else by a wide margin. $1 invested in its stocks would have grown to almost $2,000. The next best thing would have been gold, which only grew to about $70. That's not even close. The conventional thinking, especially right now, is that gold is the best way to beat inflation. But as we can see over long periods, that has not been the case at all. This is why it's so important for long-term investors to have stock exposure, because over time, stocks have not only kept up with inflation, but they've also outpaced it by the widest margin. And that's helped investors grow their money in real terms. Now what's interesting is that even though the stock market has done well, the average investor has not. The blue bar that we see on this chart shows the average annual returns for the U.S. stocks over the past 20 years. The red bar shows the same thing for the average individual investor. Not only did investors on average earn much less than the market, but they barely kept up with inflation, which is shown as the green bar. And in fact, they would have been better off just sitting in a savings account, which is shown in yellow. So what's going on here? Why can't people keep up with the market? Well, nobody knows for sure. Here's a pretty good explanation. This chart shows us a couple of things. The red line shows us the annual returns of the U.S. stock market over the past 20 years. The blue bars represent the changes in the amount of money going in and out of the stock market each year. In other words, when the blue bars go up, it means people are buying stocks, and when they go down, it means people are selling stocks. Now take a look at 1991. That year, the stock market went up a lot, reflected by the peak that we see in the red line. Now, all else equal, we could say at that point, stock prices were high. At the same time, the height of the blue bar shows us that people were also buying a lot of stocks in 91. We basically see that same pattern throughout the 1990s. Now look at the early 2000s. This was the time of the tech crash, which I'm sure most of us remember. By 2002, the market had dropped by a tremendous amount. And looking at the red line, we can see that at that point, stock prices were very low. And yet the blue bar shows us that people were selling at that time. In other words, people were buying high and selling low, which is exactly the opposite of what we're supposed to be doing. In 2003, people bought high. In 2008, people sold low. In 2009, people bought high, and I think you get the picture. This happens over and over again. We're looking at the past 20 years here, but we could look at any market cycle and we'd probably find similar results. I know it looks crazy and it doesn't make any sense, but in defense of the average investor, people aren't trying to lose money on purpose. If people knew that the market was going to start a nosedive in 2000, nobody would have bought in 99. In 99, people thought the market was going to go up forever, just like they thought it would go down forever in 02. The point is that it is very difficult to accurately time short-term market movements, and it's utterly impossible to do it consistently. And yet, many people assume they know exactly when to jump in and out of the market from year to year, day to day, or even from 1 minute to the next. The reality is that the more often we try to time the market, the more chances we have to be wrong and to potentially lose money. Meanwhile, what we really want is to increase our chances of being right and for making money. So the question is, how do we do that? This chart shows us the annualized returns for U.S. stocks over 1, 5, 10, and 15-year holding periods. The holding periods are based on calendar years from 1925 to 2010, and the three colors represent the highest, lowest, and average returns for each period. We'll go over an example to make things really clear. Look at the table below the chart, and look at the first column that reads 1 year. This column tells us that the highest 1 year return was 57%, and the lowest was negative 37%. Another way to look at this is to think that if I had randomly jumped in and out of the market for 1 year at a time, I could have made as much as 57% in a year, or lost as much as 37%. That's a wide range of outcomes. That's 94% wide, to be exact. In other words, I could have made a lot or lost a lot, but on average, I would have made 10% a year. Now, let's look at the other end of the table, where it reads 15 years. At this end, I stay invested for 15 years at a time. For example, 1925 to 1939 would be the first 15-year holding period. The next would be 1926 to 1940, then 1927 to 1941, and so on. Using this approach, the best 15-year period would have earned 19% per year. The worst would have earned 2% per year, and the average period would have been 11% per year. Based on average returns alone, there's very little difference whether we hold for 1, 5, 10, or 15 years at a time. However, by holding for 15 years, the range of outcomes narrows by a very large amount. It goes from a range of 94% at the 1 year range all the way down to 17% at the 15 years range. And an important effect of this narrowing is the fact that none of the 15-year periods resulted in a negative return. As far back as we have reliable data, there has never been a 15-year period when U.S. stocks have produced a negative overall return. That's kind of surprising considering all that we've been through. Think about it. The Great Depression, World War II, presidential assassination, threat of nuclear Armageddon, energy crisis, financial crisis, and yet not even one single losing 15-year period. That's incredible. Of course, I'm not saying that it cannot happen. Who knows? Next year could create the first losing 15-year period ever. Right? There was a time when there was no 10-year losing period. The point is that extending holding period is probably the most reliable way to increase the chances of earning a positive overall return. In fact, there are many investors who swear by a simple buy and hold approach. That is to simply buy a stock index like the S&P 500 and then hold it until you make money. And as we've seen, after 15 years, we'd have a good chance of making money, keeping up with inflation, and beating the average short-term investor. One of the most famous advocates of this approach is Dr. Jeremy Siegel. He's a professor of finance at the Wharton Business School of UPenn. He wrote a book on the subject called Stocks for the Long Run. And the book practically has a cult following. Many people swear by it. But before we go and throw all of our long-term money into the S&P, I have to ask one thing. Is that the best thing we can do? And we'll answer that question in part 3 of Investing 101, which will be up shortly if it isn't already. As for now, I hope that you enjoyed this presentation or found it to be informative at least, and if you did, then please visit BCM's website at bellwethercm.com. Click on the contact page, check out the social media links, and please subscribe, follow, like, and share the content. And if you or anyone you know has questions or needs help with investing, please feel free to contact me. Otherwise, thanks for watching, and please stay tuned for some important disclosures.